I think we can all agree that nobody likes to be in debt. But what's the number one way people get into debt? Credit cards. And if you don't know how credit cards work, you are setting yourself up for failure. So in today's video, I am going to take 8 minutes of your life and teach you everything you need to know about credit cards so that you can avoid getting into massive amounts of debt, like many people do. I'll break it down into 4 easy points. And by the end of this video, you are going to know exactly how credit cards work and how you can use them to your advantage. Let's get started. Number 1, how credit cards work. A credit card is basically a small loan from the bank or the issuer of the credit card. When you swipe your credit card or use it online, the merchant receives the money from the bank or the issuer of your credit card, and you only have to pay back a portion of that money every month. Now, why would the bank lend you money that they know they are only gonna get a portion of back every month? Well, the answer is pretty simple. It's because they make money off of you in 3 ways. The first way is by charging you interest on the balance you carry from month to month. So let's say you charge $1,000 on your credit card 1 month, but you don't pay the full balance down by the next month. You'll be charged interest on that $1,000. Now, most credit cards have a pretty high interest rate, so you could be paying a lot of interest on that $1,000. The second way banks make money off of you is by charging you annual fees. Now, not all credit cards have annual fees, but many do, and these fees can be pretty expensive. For example, a lot of travel credit cards have annual fees of $95 or more. The third way banks make money off of you is by selling your data. When you sign up for a credit card, you give the bank permission to track your spending habits, and they'll sell that data to other companies who want to market their products to you. For example, let's say you use your credit card to buy a new TV. The bank will know that you have a new TV, and they'll start sending you ads for things like extended warranties, or maybe even a new streaming service. Now that you know how credit cards work and how banks make money off of you, let's move on to point number 2. This will help you figure out which type of credit card is right for you based on your spending habits. There are 2 types of credit cards: reward cards and cashback cards. Reward cards offer points or miles that can be redeemed for things like free flights or hotel stays. Cashback cards, on the other hand, offer a percentage of the money you spend back to you in the form of a statement credit or direct deposit. So for example, if you have a 3% cashback card and you spend $1,000 on it, you'll get $30 back. Now here's the thing. There is no right or wrong type of card. It all depends on how you plan on using the card. If you plan on using it for everyday purchases like groceries or gas, then a cashback card might be a better option since you will get cash back on those purchases. On the other hand, if you plan on using the card for travel, then a rewards card might be a better option since you can redeem your points or miles for free flights or hotel stays. Now, let's move on to point number 3. One of the worst mistakes you can make with a credit card is not paying the balance down by the time the bill comes due. Not only will you be charged interest on the balance you carry from month to month, but you'll also damage your credit score. Now, I know life gets busy, and sometimes you forget to pay your bills on time. But if you make it a habit of not paying your credit card bills on time, you're going to get into debt fast. In fact, according to the Consumer Financial Protection Bureau, the average American has $5,700 in credit card debt. That is $5,700 of debt that could have been avoided if people just paid their bills on time. So please, whatever you do, make sure you pay your credit card bills on time. Set reminders on your phone or even schedule automatic payments so that you never miss a payment. I personally have a rule where I pay my entire credit card balance down before the bill comes due. and you should do the same. If you can't afford to pay the full balance down, then at least pay as much of it down as you can. Any money you owe the bank is essentially money the bank owes you. So don't let the bank profit off of you by charging you interest. Number 4, getting approved for a credit card. Now, I didn't have time to go over this in the last video, but I thought it was important enough to mention in this one. To get approved for a credit card, you'll need to have a good credit score. Now, a credit score is a number that represents how likely you are to repay your debt. The higher your credit score, the lower your interest rate will be. And the lower your credit score, the higher your interest rate will be. There are many factors that go into calculating your credit score, but the most important factor is your payment history. Payment history makes up 35% of your credit score. So if you have a history of not paying your bills on time, your credit score will suffer. Another important factor in calculating your credit score is the amount of debt you have. This is known as your credit utilization ratio, and it makes up 30% of your credit score. Your credit utilization ratio is simply the amount of debt you have compared to the total amount of credit you have available. By the end of this video, you now know how credit cards work, the different types of credit cards, how to use them responsibly, and what goes into getting approved for one. Now, I know this stuff isn't the most exciting thing in the world, but it's important to know this stuff if you don't want to end up in massive amounts of debt. Trust me, it's not worth it. Now, if you enjoyed this video, I have another one here that explains stocks for beginners. I'll see you guys in the next one.